Whenever the economy is hit by a mega crisis, consumption tends to be far more robust than most people expect it to be. Furthermore, financially strong, dominant franchisees consolidate their market share during the crisis. Additionally, stock markets in the decade following the crisis tends to be extremely productive for investors. No absolutely no one can forget the first quarter of 2020 when COVID 19 first showed up its ugly face. Equity markets across the globe fell by over 20 to 30%, and the economic activity was completely stalled. So much so that for the quarter ending June 2020, India's economy contracted by 24%. But since then, or let's say from April till date, equity markets have rallied onto all time highs. Now, why is it that the market is rallying, and what is this consumption theory? Let me try and explain to you in this video. And I thank Team Marcellus for the content of this video. Let me reiterate, consumption recovers swiftly after economic exigencies. Even after the Spanish flu of 1918 to 1920, the consumption continued to recover till 1929 at the rate of 3% in real terms. The same happened after the World War was over in 1945, where the economy recovered till 1950. Even during the 2008 financial crisis, the same kind of pattern of quick consumption recovery can be seen. These three different kind of pandemics show that they yield the same results. Consumption in the long run doesn't get affected. But why is it so? Given that these three different scares were of different intensity and of different nature. Let me introduce you to permanent income hypothesis. Permanent income hypothesis was postulated in the year 1957 by Milton Friedman. In specific, government tends to opt in for increased spending and tax cuts during crisis to spur up the economy and consumption. His PH theory, on the other hand, believed that the consumption is a factor of average future income and not just current or immediately foreseeable future. He did observe that human beings are forward thinkers. They believe future holds very good for them and also believe that the crisis is short-lived. So for all those people who have lost their jobs or have to do with lower income during crisis, they expect it to be short-term in nature. Provided the perception of the future income hasn't changed much, the consumption level comes back to normal once the crisis abates. The stock market understands PIH. Like consumers, the stock market too looks forward and discounts the future. Let's assume that a market leading widget manufacturer with a dominant franchise is fairly valued at $100 pre COVID. Assume that this value emanates from the next 20 years of profit at the rate of $5 per annum, of course, discounted back to the present. Then COVID 19 enters the picture and impacts the widget manufacturer in two ways. Firstly, it wipes out its current year's profit completely. Secondly, it financially weakens the said company's competition that are relatively more and thus allows a dominant player to gain certain market share through COVID-19 crisis. For calculation purpose, let's assume that there is a 10% plus points of market share for the next 19 years. Therefore, there will be a profit of over $5.5 per annum. Now, as per any simple DCF model, the widget manufacturer's fair value is 19 into 5.5, which is $104.5. This simple model allows us to understand why across the world, well-managed dominant franchisees have seen their stock price soar even as the real economy has struggled through COVID. In conclusion, in the last century, there have been four such exigencies comparable to COVID 19 in terms of scale and severity. They are Spanish flu, World War I, World War II, and GFC, Global Financial Crisis. The US stock market has rallied every time once the crisis abates. Both in financial market and real economy, the past belonged and the future belongs to those who assess risk rationally than emotionally. Therefore, my advice is to please assess risk before investing. Hope you like this video. Please do subscribe for more such videos. Thank you.